I'm your friend Cosmo. In today's video, we'll discuss on how to manage risk. First is diversification. So we need to do a lot of diversification while we are managing one portfolio. First is asset class diversification. What is asset class diversification? Asset class like stock, bond, real estate, commodities. These are different asset class. Nowadays, crypto also one kind of asset class. Okay, so we need to invest into different asset classes. That is called asset class diversification. Next is sector diversification. We need to invest into different sectors. Different sectors like banking, FMCG, pharma. These are different sectors. So we need to do different sectorial diversification also. Third level. Third level is geographic diversification. So our portfolio, we should not invest in only in India. Yes, India has very good growth potential. So maybe in our portfolio, 70-80% we may invest into India, but 5 to 10% we may do diversification into maybe US, China, or other countries, other emerging countries also where you have very good growth potential. Next is asset allocation. In this asset allocation, risk tolerance assessment is very much required. What is risk tolerance assessment? Say, for example, we need to understand how much risk you can take, okay, in your portfolio. So next is rebalancing. Rebalancing also very much required every periodical basis. Say, for example, you just started your investment over the period of time, uh, depending on different factors, we need to do periodical rebalancing. Maybe once in a year or means once in a year is a good enough time because we need to see the tax impact also. So we may need to do rebalancing. Maybe initial first year may not be, it's very much required because maybe second year, third year onwards, once in a year, periodical rebalancing is very much important. Then dollar cost averaging or rupee cost averaging. So when you do systematic investment, so what had happened? You invest in different part. So say for example, equity is like zigzag like this. So when you are investing in different market level, automatically here, rupee cost averaging is happening or dollar cost averaging is happening. Next, you need to do hedging. What does it mean by hedging? So in your portfolio, maybe some hedging like uh, maybe you may hedge your portfolio through future option, this kind of strategies. Or if you have excess investment into equity, you may invest into gold for hedging purpose. Professional advice. You should be with professionals to guide you because uh, initially maybe for it is like a fund you just invested one or two mutual fund or one or two stocks. But when it become one sizable asset, that point of time you need clear handholding. If you good enough to understand finance good, then you may go for directly you may invest. Otherwise, when you don't have enough knowledge, enough expertise in that point of time, you need to be with one financial expert. So when they come to any expert, that point of time, their portfolio is very much organized and different based on their risk appetite, goals, and all. They are very much organized and very much disciplined in this particular thing. One more thing, when you are not with professionals, that point of time when market downturn come, when actually you need to invest, people like fear comes to them and they started withdrawing money. Okay, so that is why you should be with professionals. So then continuous monitoring is a part of risk management process. So continuous, you need to monitor in different layers. One maybe granular level, maybe individual stock level, then strategy level, then maybe mutual fund level, then overall economy level, then overall global perspectives, and different asset class perspectives. There could be a number of monitoring should be there. Review also very much required because multiple cycle comes and re review, but review does not mean ki immediately you need to react. Okay, so review means you need to see, you need to understand what is going on and what could be future trend, and accordingly what you need to maybe out of review your changes, maybe 20, 30, 40%, maybe less than 10% sometimes you no need to change anything, but review is very much required. So you need to assess your risk comfort. What does it mean? If there is loss in the equity or in your portfolio, so how much loss you can bear, and for how many, uh, what is the time period, for how much time period this loss you can bear. So that kind of risk comfort you need to assess. Then different risk assessment tools. So we have a lot of templates, a lot of tools. So we normally give our customer for risk assessment. Then you need to research. You need to do your own research before investing. Like when it comes to stocks, you need to do your own research, valuation ratios, growth potential, then its earning. So a lot of things you need to do your own research before your investment, or else you need to go to your any investment expert or any investment advisor or mutual fund distributor. They will help you out for this particular uh, big thing. As I discussed with you before also, you need to hedge your risk like option, then you need to invest into commodities, then your portfolio should be diversified, like different diversified strategy you need to invest into, like multi-asset kind of portfolio, like balance advantage kind of portfolio. So this kind of hedging you should do in your portfolio. You should maintain one emergency fund. So emergency fund is very much required. For 3 to 6 month ka emergency contingency fund you should create. Okay, and that should be in very much into liquid form, or very maybe in your savings bank account, some part into fixed deposits, some part maybe into liquid mutual funds. So so avoid emotional investing. Okay, so you should avoid greed and fear. So this emotional aspect you need to manage very tactically. You should have long-term plan. If you have long-term plan, that is when you can ignore short-term noises. Most important thing is have clear financial goal. So that is why we believe in approach called financial planning and retirement planning approach. So when people come to us, normally we go with these two approaches. So you should have to have clear financial goal. That is why when people come to us, that point of time we do financial planning and retirement planning first. Website planfuture.in, and you can see. So this is our process flow. So when any customer come to us, we do introduction meeting, then we collect data from customer, then data understanding meeting, then personalized plan meeting, plan and data insight discussion, help you in plan execution, tracking your plan, and periodical review. And every 3 to 6 months we do re-financial planning. And this is our quality policy. We are very much data driven distributor of financial product. So we give, actually we tied up with cutting edge top class technology, trusted product which is comes under regulatory framework. Then we are very much process driven. We are structured. We actually believe in risk adjusted potential upside. We will give you one-stop solution for execution solution. We are not any kind of brand or product bias. We are customer interest bias. And in our core policy, we have empathy on customers' goal achievement. So we are very much careful how you can achieve your goal. Hope this session is very much useful for you. And we actually help people from across India, NRIs from across globe. So if you are any part of India, you can contact us in our given number. You can reach out to our website. Thank you. Happy investing.